Good evening and welcome back to Be Rich. My good friend and nephew Shashwat Swaminathan is here with us and we are going to discuss Bridgewater Associates. For those who do not know what is Bridgewater Associates is the hedge fund firm founded by Ray Dalio. Its chief investment officer Bob Prince has written a piece on stagflation and what investors should do in financial times. So I thought we would discuss that. While I agree with most of what Ray Dalio says, I do not agree that the power is shifting to China. For a country to be the reserve country in the world, its currency to be accepted as reserve currency, it should be a free and a liberal democracy where rule of law prevails. Unfortunately, as we have seen now, in the case of Jack Ma, Tencent and Didi, they crack down on tech. It is clear the rule of law does not prevail in China. It's ruled by law rather. Therefore, I do not believe that RMB qualifies to be a reserve currency. Whereas Ray Dalio believes that the shift is happening. Maybe he's right, maybe I am right. But if China wants to become a democracy, then there will be a lot of changes in its economy and a lot of dirty laundry has to be had in public. And that will take at least 2 decades. And in those 20 years, dollar will continue to dominate. For all its feeling negativity about United States, of which I agree with most of what he says, America remains a liberal democracy, where to an extent rule of law prevails. There is a democracy, and we should remember that America and England are the only two places where an authoritarian regime was overthrown in democratic methods. That is not possible anywhere in the rest of the world in the current atmosphere. Anyway, so let's dive in and look at what Bob Prince. What is the first point in his article?
So the first point he makes in his article is that the situation is not as simple as it seems. It's not that there's inflation and they've raised the rates and now it's going to be tackled. First, he says inflation may be entrenched. In the case that inflation is entrenched, and this is something which we discussed as well, raising interest rates might not directly tackle inflation. And you said Larry Summers also echoed the same sentiment, where going from 8 to 4 might be possible, but going from 4 to 2 is a tough ordeal. So under that condition, Bob Prince says that stagflation might be imminent. So with stagflation in mind, the first outcome he looks at in the macroeconomic scale is Europe. He says that the increase in cost of energy prices has absorbed most of the nominal spending, leaving little room for real growth. And two, he has said that the euro is depreciating. That is, it's a fact. Euro is depreciating against the dollar, and he's saying that this is leading to a rise in import costs, further taking a toll on real growth. So that is for Europe. So in that case, where there is persistent inflation but real growth is decreasing at the same time, he says that stagflation is imminent. What do you think about that?
I do agree that the Russian-Ukraine conflict, that increased gas prices have taken away most of the nominal income, and there is no real growth. And entrenched inflation is in turn hurting growth. Entrenched inflation in turn is also hurting growth because it is sucking out all the nominal spending. But he misses at this point a larger problem in Europe, which is the population problem. In another 3 or 4 years, the number of Germans will be less than what they were in 1950.
Okay.
And they are a rapidly aging population.
Okay.
So they need a lot of migration from Asia and Eastern Europe to stabilize their population. An aging population means lower growth, lower profits, and lower equity returns, which is also stagflation because there will be no growth.
Yeah.
There no consumption. Consumption will decline. Consumption for only one particular group of set of geriatric products will be there. So these countries have gone to a point where their fertility has dropped below a point and they have started to decline
below
in population.
The replacement rate.
Yeah, they are far below replacement rate. He doesn't make that point. So the structural is not because of gas prices. Maybe in 5 years from now the Russian war is over, Putin is throat and gas comes back. But that's not the problem. The structural problem in Europe, Western Europe, is the lack of new babies.
Okay.
So he is right that there is going to be low growth. Now whether inflation is entrenched is like you have to crush out inflation by taking interest rates higher.
Right.
Now what is now, there is not even 0.5, 0.25 or 0.1. 0.1 is also not reached in Europe before people are crying. If you take inflation to 3, if you take interest rate to 3 or 4%, you will crush inflation wherever it is.
Right.
You will destroy demand basically.
You will destroy growth.
You will destroy, anyway growth is going to get destroyed.
Yeah.
So you cannot have twin objective of crushing inflation at the same time having growth.
Yes.
So you have to crush
inflation.
So the rates have to go up. Normally interest rates turn once in 15-20 years.
The regime.
The interest rate cycles. These are longer cycles. The interest rate cycle started going down in 2000. Now we are in 2022.
Yeah.
So I see this as a reversal in interest rate cycles. So next 15 years, equity returns may be lower.
Okay.
There is a book called The History of Interest Rates by Sidney Porter, I think. I have that book. And he talks about interest rate cycles for the last 3000 years. So there is a 15 to 20 year period when interest rate cycles turn. And whether you can increase interest rates today, or like he is suggesting, they can chicken out when it is going to go to 4. And when you cut rates, it will again, inflation will go back to 8.
Yeah.
As quickly as it went from 8 to 4, it will go back from 4 to 8.
Right.
And you can lose a decade. Anything can happen.
Yeah.
Because politicians are now eyeing only the next election.
Yeah.
Politicians are not thinking in 10 years.
Yeah.
If you look at the British system, the Conservatives have won 4 elections in a row, but they are going to have their fourth prime minister, I think. I think there was David Cameron.
Yeah.
Then you had that lady Theresa May.
Yeah.
Then you had this joker Johnson, and you are going to have the fourth prime minister.
Yeah.
But the same party has been in power for 12 years.
The Tories.
The Tories.
Yeah.
So politicians don't think in terms of 1 year and in 10 years and interest rates. They think of next election cycles.
Right.
So it is quite possible if the pain becomes too much and inflation drops to 4, they may hold off on the pressurizing it with interest rates. Believe me, then inflation will climb up again.
Yeah.
Till a point of Volcker comes and really crushes inflation.
Yeah.
So I agree completely stagflation, but the longer trend play is the population, which he is not talking about.
Okay. And so moving on, he says equities, as you had said, are the worst affected by this because they get hit on two accounts. One, great beyond normal inflation, and two, a decrease in growth. Both of these hit equities like a double whammy. Although inflation in mild numbers might, although proven to be good for equities, inflation in an extremely high number is not always good for equities, is what market data has shown.
No, there's a triple whammy.
Yeah.
As interest rates go up, like the great Warren Buffett says, they act like a gravitational force on profits. So they are going to eat into profits also. Debt eats into equity.
Yeah.
So there is going to be a triple whammy, not a double whammy.
Right. So he says equities are what is going to be affected most, and he in fact advises most to reorient their portfolio and shift away from equities. What do you think about that?
I agree completely.
Okay. And now the question comes to bonds, which is a more tricky subject to tackle. He says that so when it comes to bonds, he says in an environment of low growth, which means lower interest rates.
No lower interest rates.
So he gives. So I'll get to that. So he gives, there's a cross section or a cross cutting effect. He says there are two ways in which, so you had said they can chicken out due to low growth. So that's the scenario he's talking about. So he says, let's say growth, it demolishes growth, raising interest rates. Interest rates will crash back to whatever level it was before because he's...
then bonds will look like a genius investment.
Exactly. But he says it's also balanced off by the probability that due to higher inflation, a Volcker type crackdown on inflation might lead to bonds being sold at discount prices, current bonds that is.
Yeah, but what I'm saying is, if you are buying fresh bonds at higher yields, and if you can hold it for a 3-year or a 4-year period, then you will ride through this Volcker cycle also. Okay. See, Volcker cycle cannot last beyond 3 years.
Yeah.
So at every yield, like you buy stocks at every fall.
Yeah.
If you keep accumulating bonds at every fall and ride out the cycle, you would have made a big profit on the bond market, and you can sell and move to the equity at the right market.
So bonds in a way work just like stocks where you keep buying when it falls.
Every time yield falls, you buy more bonds.
So it's a lot like stocks, but the only thing is that the face value is higher.
It's much higher.
Right. Then he comes to inflation-linked bonds, which I think is an interesting topic. So he says inflation-linked bonds, you're going to benefit even when there's low growth, and you're going to benefit when there's higher inflation.
Yeah, but what will happen when inflation is crushed?
Then you have low growth.
Yeah, but then you'll still have no return, no? If inflation comes to 0, my bond will give me 0 returns.
No, but it's a margin above the inflation rate where you are guaranteed some sort of real return.
If it is 1 or 2% above inflation,
yeah,
it makes sense.
So there needs to be enough of a margin. And there's one more problem I identified with inflation-linked bonds, especially with the case of India, where you had at multiple points.
See, the problem in inflation-linked bonds is I don't trust the inflation figures put out either by Federal Reserve nor the Reserve Bank.
Yeah. So you don't know whether the numbers which they're reporting is accurate, so you don't know what your real return is on the bond.
Yes, exactly.
And then coming to gold and commodities, he says these can also be, he doesn't recommend that you get into commodities, but he says theoretically speaking, commodities are an asset class which you can look at. And he says gold is another asset class which you can look at.
See, gold will continue to fall as long as interest rates climb. Gold is inversely proportional to dollar.
Yeah.
Gold has deeply corrected now, which I said it would correct, which has been my position. So you should buy gold. And as it dips, if you keep on buying gold and you can last for 3 years, nothing like that.
Right. And commodities?
See, I don't know whether I want exposure to crude because crude went way high. So I am iffy on crude. But I don't mind taking up exposure to all the other metals. Metals is relatively a decent space to be, and crude must be a good space because Buffett is putting a lot of money in crude.
But that's my question, because if you're going to have a recession in the US, how are commodities supposed to withstand a...
Again, you are not looking at a recession is only 3 quarters or 4 quarters. You cannot have a 3 quarter, 4 quarter outlook in an investment.
Yeah.
An investment horizon must be at least 3 to 5 years.
So in the next 3 to 5 years, you think commodities might do decently well?
I think, again, it depends on the two things. If there's a Volcker type move, then commodities will continue to fall.
Yeah.
So you can keep buying in falls. If they do a false move, that is the Jam Paul chicken soup, then commodities will rally and you look like a genius.
Okay. And so there are two other concepts he talks about. One, the discount rate. Number two, he talks about how risk premiums change.
So how much he says discount rates will go up or come down? It will keep going up as long as they tie up. Discount rate is also dependent on the risk-free rate.
Right. So that's interest rate, and he's also talking about risk premiums.
Yes, the premium I will demand to make an investment in venture capital will become far higher because capital is scarce. That I'll talk about.
The yield spread.
Yeah, I'll bring in Howard Marks also. I don't remember his diagram, but I know risk
It's
is
a
not.
scale.
Yeah, risk is not a standard deviation. That is volatility.
He goes from US treasuries, then he goes into municipal bonds, then he goes into corporate bonds, then he goes into equities, then he goes into hedge funds, leveraged hedge funds. So he talks about two other metrics. He talks about discount rates, one, and second, he talks about risk premiums which are demanded during stagflation. So what do you think of those two?
See, what is discount rate is nothing but the risk-free rate, dependent on risk-free rate plus how much you get.
Right.
Now, when if the Fed is buying mortgage-backed securities and corporate bonds, it's forcing the investor to take riskier bets at very low premiums. Right. Discount rates are very low. If the Fed increases the rate, then what happens is the investor will sell the risky asset and move into safer assets like US Treasury.
Yeah.
So that's how it matches. As discount rates increase, the ability to take risks, people don't want to take risks.
Yeah.
And therefore, it answers to the second question. In a stagflationary environment, interest rates are higher, and therefore, the difference between the premium demanded for taking a risk will also increase.
Because returns have already gone from negative real returns to positive real returns.
If they have not yet gone, the moment they go to positive real returns, it will be very difficult. In fact, in America, I look at a lot of bankruptcies, and in lot of junk bonds, I'm looking forward to defaults.
Right. And finally, if there is an incoming period of stagflation in the Western world, how do you see it affecting India?
India's exports will be badly affected. India's merchandise exports will be badly affected, and India's IT exports will also be badly affected.
So TCS, Infosys.
Yeah.
Okay.
But the rupee will have to give. The Reserve Bank is desperate to defend the rupee, right?
Right.
So the rupee will depreciate to balance the exports in IT. But really the consumption will come down. So the consumption, that is merchandise exports, will be down. But the other thing that will happen, there will be a big wave of migration from India to Western Europe, which already I can see. When I was much younger, I didn't see kids moving to Germany and Netherlands. Today there's a very big Indian population in Germany and a big population in Netherlands, both xenophobic countries.
A lot of my classmates, in fact, have looked to settle in those places. They've gone to college there and they're planning to settle there.
Yes, so that is the change.
4 classmates out of 30, or around 4, have gone to the Netherlands.
So what I'm trying to say is, this is the result of not only stagflation, and this is because those countries are more welcoming to
immigration.
immigration.
Okay, that's all I have for you today.
Thank you very much. I hope you enjoyed this conversation I had with my nephew. Kindly do not forget to press the subscribe button and hit the bell notification. If you do not hit the bell notification, you will not be notified about new videos we put out. Once again, I thank you for your support to Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.